Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing a significant jump in Ontario's mortgage delinquency rates, which have increased by 50% above pre-pandemic levels. According to Equifax Canada's latest quarterly credit report, over 11,000 mortgages in Ontario had at least one missed payment in the fourth quarter of 2024. This figure is nearly 3 times the number recorded in 2022, indicating a growing financial strain on homeowners as they face the high rate renewal shock that's been anticipated by experts. Rebecca Oakes, Vice President of Advanced Analytics at Equifax, highlighted that mortgage holders generally strive to maintain their payments. However, the sharp rise in missed payments suggests that many are experiencing deeper financial challenges. 2 primary factors contributing to this delinquency include the significant increase in home prices during the pandemic and the higher interest rates homeowners now encounter upon renewing their mortgages. Interestingly, while some consumers are benefiting from lower interest rates, financial pressures have intensified for others, particularly in regions like Ontario and British Columbia. An example is Pushkar, a software engineer in British Columbia. When he purchased a townhouse in 2022, he opted for a variable rate mortgage at 4.8%, expecting rates to rise but not as swiftly as they did. His payments have become more challenging, with much of his monthly contribution going towards interest rather than the principal. In light of these challenges, financial experts like Richard Goldhar, a licensed insolvency trustee, advise those struggling with mortgage payments to seek support from family members and communicate openly with their mortgage lenders. He suggests exploring deferral programs or interest relief options and seeking budget counseling to better manage expenses. The report also notes a sharp increase in the number of people in Ontario who are behind on their mortgage payments by 90 days or more, with this delinquency rate rising by 90% year over year. This increase far exceeds the delinquency rates in other provinces, such as Quebec and British Columbia. Rebecca Oakes pointed out that an early warning sign of financial distress is the rise in non-mortgage debt. In Ontario, the 90-plus day non-mortgage balance delinquency rate jumped 46.1% year over year, with the overall non-mortgage delinquency rate rising 23.9%, surpassing the national average of 18%. The total consumer debt in Canada at the end of 2024 reached $2.56 trillion, a 4.6% increase from 2023, largely driven by non-bank car loans. Toronto ranks 3rd in Canada for non-mortgage delinquency rates following Fort McMurray and Edmonton. As financial disparities grow across Canada, some borrowers, particularly those with higher incomes or living outside high cost of living areas, are benefiting from lower interest rates. Meanwhile, others are struggling with increased debt levels, particularly those with high balance mortgages. The coming year is expected to be critical for Canada's economic stability, especially with more than 1 million fixed-rate mortgages set to renew in 2025. Many of these were initially taken out when interest rates were below 1%, but now they face a renewal rate of around 3%, leading to significant increases in monthly payments for many homeowners. Senior BMO economist Sal Guattieri has highlighted the potential savings for mortgage borrowers opting for variable rates, which could amount to over $6,000 on their next term. This insight is based on BMO Economics' latest research, pointing out that variable mortgage rates are becoming increasingly attractive compared to fixed rates. The expectation of additional Bank of Canada rate cuts this year supports this perspective, with the bank suggesting that variable rate mortgages could offer long-term savings for borrowers. Guattieri writes that borrowing costs are more likely to fall than rise, especially in the context of a possible trade war, making a floating rate mortgage potentially more beneficial. Although current variable mortgage rates are on par with, or slightly higher than, 5-year fixed rates, They are expected not to remain at this level for long. The pricing of variable rates differs from fixed mortgage rates, as they are tied to lenders' prime lending rates, which follow the Bank of Canada's overnight policy rate. This rate currently sits at 3%, with the prime rate offered by major lenders at 5.2%. Most economists anticipate further rate cuts by the Bank of Canada this year, in addition to the 6 consecutive cuts made last year, which would lower borrowing costs for variable rate mortgage holders. BMO's forecast suggests the Bank of Canada's policy rate could fall to 2.5% by the end of this year, or even to 1.5% in the event of a full-fledged trade war with the United States. Under the base case scenario, this would likely lower the prime rate below 4.5%, enabling today's variable rate borrowers to achieve meaningful savings. Other major banks share this outlook, with institutions like CIBC, National Bank, and TD expecting the Bank of Canada's policy rate to drop to 2.25% by year-end. RBC is even more aggressive, forecasting a decrease to 2%. With these potential rate cuts, more borrowers are considering variable rates. Data from the Bank of Canada indicates that nearly a quarter of new mortgages were variable rate by November, up from less than 10% earlier in the year. Mortgage broker Ron Butler has observed a significant increase in the share of variable mortgages being originated, rising from 7% last year to 40% today. BMO argues that choosing variable rates now positions borrowers for lower payments in the near future. Guattieri estimates that a borrower with a 10% down payment on a $500,000 home financed over 25 years could save an average of 40 basis points per year compared to locking in for 5 years. This translates to just over $100 per month or more than $6,000 in 5 years. In a scenario where a trade war with the United States impacts the economy, Guattieri suggests that savings for variable rate borrowers could be even greater, with an additional 29 basis points saved on average over the 5-year term, or an extra $74 per month. Guattieri also notes the flexibility of variable rate mortgages, as borrowers can lock in if rates unexpectedly start to rise. While there is inherent uncertainty, he believes the greater risk lies in locking into a fixed rate and missing potential savings. However, Guattieri acknowledges that there is no guarantee the Bank of Canada will continue to ease rates. If the bank decides to hold steady, locking in could prove moderately beneficial. Moreover, if the economy strengthens and inflation reemerges, the bank might reverse some rate cuts, making a fixed rate a better option. For borrowers who are risk-averse, a shorter-term fixed rate may serve as a compromise. Currently, 3-year fixed rates are slightly lower than 5-year rates, offering flexibility to refinance sooner at potentially lower variable rates. According to BMO, this strategy could save borrowers about 20 basis points per year over 5 years, compared to locking in for the full term today. While this is still 20 basis points higher than opting for a variable rate now, the extra cost may be justified to hedge against possible rate increases. Let's shift our focus to some positive news in the real estate sector. The federal government, alongside the City of Toronto, Wood Green Community Services, and Michael Garron Hospital, has officially opened a new affordable and supportive senior housing project in Toronto. The project, located at 1080 Queen Street East, consists of 9 newly converted cluster care units in a former commercial space. These units are owned by Wood Green Community Services and operated in partnership with Michael Garron Hospital. This initiative is part of a broader effort to provide seniors with the support they need to age in place with dignity and independence. The cluster care units offer daily assisted living services, including personal care, meal preparation, laundry, medication reminders, and household support. The first residents are expected to move in by the end of February, with full occupancy anticipated by March 15th. Funding for this project includes $1.6 million from the federal government's second round of the Rapid Housing Initiative, as well as additional contributions from the City of Toronto and private donors like the Dr. Alan Carswell Family Foundation. The Rapid Housing Initiative, delivered through the Canada Mortgage and Housing Corporation, aims to facilitate the rapid construction and conversion of buildings into affordable housing. The Honourable Nathaniel Erskine Smith, Minister of Housing, Infrastructure and Communities, emphasized the importance of innovative models like the cluster care units in creating permanent, affordable homes for seniors. Meanwhile, Toronto's Mayor Olivia Chow expressed pride in the collaboration among various partners to provide secure homes for seniors, allowing them to age with dignity. Anne Babcock, President and Chief Executive Officer of Wood Green Community Services, highlighted the significance of this project as their 7th cluster care site. She noted that this model provides affordable housing and 24-hour personal support in a shared living environment, promoting independence while ensuring necessary care. Melanie Cohn from Michael Garron Hospital echoed these sentiments, stating that the partnership exemplifies how working together can meet community needs. She noted the importance of delivering support to vulnerable citizens while maintaining an environment that promotes independence. The National Housing Strategy, a long-term plan from the federal government, supports initiatives like this one, aiming to ensure every Canadian has access to affordable housing. This strategy prioritizes those in greatest need, including seniors, Indigenous peoples, and others experiencing housing insecurity. With the third phase of the Rapid Housing Initiative, over 5,200 new homes are expected to be created, with a significant portion designated for women and Indigenous peoples. The initiative takes a human rights-based approach, serving people experiencing or at risk of homelessness and other vulnerable groups. This project at 1080 Queen Street East is a testament to the impact of collaborative efforts in tackling housing challenges. It demonstrates how government support, community services, and healthcare providers can come together to create sustainable housing solutions.